We're going to look at Service Properties Trust today, and this is a REIT. And what I do in the video is I'm going to do a discounted cash flow model on this company and figure out the intrinsic stock price. And I'm going to show you step by step how I do it. So let's get started with the model. They have a market cap of $1.08 billion, and their share price is $6.58. So now we know the shares outstanding because it's the market cap, $1.08 billion, divided by the stock price, $6.58, equals 164 million shares outstanding. Next, we're going to get the free cash flow. And this is how you value a company. You estimate the future free cash flows, and then you discount those dollars back to today's value. And that's exactly what we're doing in this video. Free cash flow is the cash that's left over after operating your business minus capital expenditures. Next, we're going to get the net income, and that's on the income statement, and that's the profit and loss. And then we're going to get the revenue, which is the sales. And we'll put 4 years of each into the model. And we'll take a quick look at the numbers. You can see free cash flow is fairly steady each year, 500 to 600 million. Net income is also steady, 180 million to 260 million. And revenue seems to be increasing every year a little bit. So these are all good signs. And the only way you could really value a company is if they have consistent numbers. Because if they're really inconsistent, or if they have a lot of negatives, it's really hard to value. Now let's figure out the capital structure of the company, so we know what discount rate to apply to the future cash flows. They have interest expense of $225 million. That's the interest they pay in their debt. And let's see how much debt they have. We'll go to the balance sheet, and we'll go to the liabilities section. Long-term debt of $6 billion. That's debt due after 12 months. And they pay 3.71% interest on their debt. And now let's get the cost of equity. We need the beta for that. That's the volatility of a stock. And they have a pretty high beta, 1.94. So the stock moves about twice what the market does. So if the market goes up 1%, this stock should go up 2%. If the market goes down 1%, this stock should go down 2%. Let's get some more information from the balance sheet. We'll get the current assets. These are assets which can be liquidated into cash within 12 months. They usually include cash, accounts receivables, and inventory. That's 237 million. Let's get current liabilities, and these are liabilities that are due within 12 months, and that's 356 million. Let's get their equity. That's the value of the company according to the balance sheet. That's 2.5 billion. That's total assets minus total liabilities. And let's get their EBIT. That's on the income statement. They call that operating income. That's 414 million. That's 1 year of operating income. Now we can see the weighted average cost of capital, because it's a blend of the cost of debt, 3.7%, and the cost of equity, 17%. And that comes out to 7.66%. And that's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows. We also did a terminal value, which is all years past year 4. We discounted those numbers back to today's values. And then the sum is 5.2 billion. That's what we say the company is worth according to its financials. And when we take that 5.2 billion and divide it by the shares outstanding, the 164 million, we get a calculated stock price of $32. It's trading at $7, so it's trading at a 79% discount. So it's a buy according to the model. Let's see what Simply Wall Street says the stock is. And they're also considering it a buy at $34. So it seems like both our models consistently say the stock is extremely undervalued. 33.61, and I'm at 31.82. So my numbers are usually fairly close to Simply Wall Street. Sometimes they're a little off. So we must use similar assumptions. Now, if you look at the historical stock price, it was trading in the mid-20s. for a few years, and it dropped when coronavirus hit. A really good price to earnings ratio of 4.2, and that means investors are willing to pay $4 for $1 of earnings. Generally, a price to earnings of under 15 is a good value. And the average in the market's 28, and the median in the market's 15. They also have a really good price to sales ratio of 0.5. Price to book is really low at 0.4. Current ratio is below 1, which isn't good. That means that current assets are below their current liabilities, and they can't cover their current debts. ROE is low at 10%. I like to see a little higher than that, around 20%. They cover their interest payment almost 2 times, which isn't so great. So they definitely need a little more funds to come in, because you want to see a bit higher for the interest coverage ratio. The median in the market is 6. And they have a decent amount of debt at 71%. So I have 13 REITs I've done on this channel. So let's compare their ratios to the other companies. So the average REIT has a PE of 46, and they're at 4.2. So they're definitely at the lower end. And some REITs are real low, like MFA has 2.0. Their price to sales is well below the average. Average is 6.6, they're at 0.5. Their price to book is really low at 0.4. Current ratio 0.7, that's well below the average of 3.1, so they're struggling in that category. Could be a timing issue, maybe next quarter it'll be better. So you should look at ratios over several quarters. ROE at 10%, that's a little less than the average of 12%. Their debt is higher than average. Average REIT is 64%, they're at 71%. And they are a little smaller, they're a $1 billion company compared to the average REIT of $11 billion. That's just because American Tower is just a massive company. It's actually bigger than the other 12 REITs combined. Thanks for watching the video. Please leave a comment.